All right. Well, it's been quite the start to the year. 2021 is trying to follow up of 2020 with its own kind of craziness these first 3 days. Of course, everything we saw on TV in Washington D.C. Um, completely unacceptable in terms of how we function as a country and as a government and as a people. With that said, um, the markets seem to shrug it off. The markets had a little bout of volatility midday, but I think the markets just kind of show how apolitical they are, and that's why we don't get too much into politics here, because the market doesn't care. The market just cares about results and expectations and how and uncertainty or uncertainty and there was, like I said, a little bit of a bout of volatility today, but nothing that would alter the trend, the current bullish trend that we're on. So we did hit some pretty extreme bullishness today. So I'm going to share an extreme pattern. If you don't follow me on Twitter, I tweeted out what that was. Very extreme, like one of the most extreme that we've seen in the small cap index. We didn't finish at the end of the day, but still very telling move in the Russell. So I'm going to break that down. I'm going to break down then, okay, what do I expect then? Do I expect that we'll tank right now or drop? Or, as I mentioned on Monday, are we still going to kind of move higher despite this? So we're going to talk about that, what kind of divergences might be setting up, and where we can go from here. And then for our trade idea of the day, we'll take a look at a stock that's outperforming its sector and kind of showing what the rest of the sector might do coming forward into the last part of this week and into next week. So let's go ahead and get started. Today is Wednesday, January the 6th, 2021. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. You can see we've continued the bounce from Monday. We talked Monday night about that's probably not going to start this intermediate decline. There's a lot of noise. That's continued to be the case today. We did pop up to a new high, so I actually have to move. Right here, let me move this Fibonacci line up here to the top, to that high point. But you can see still pretty noisy. We did get a little bit of a long upper shadow. We'll see how much that plays out. More than likely we'll still trade up inside of that range over the next day or two, probably by the end of the week. You can see the posture is still strongly bullish. The market sentiment is strongly bullish. So, we can't be too bearish when the market posture is so strongly bullish. The near-term line's also up, coming back up from the lower half of the chart. The momentum line's down, so they're kind of crisscrossing. The momentum line down because we're coming off of that long upper shadow. The Russell 2000, it came for most of the day today, if you follow me on Twitter, for most of the day, the Russell 2000 was flirting with an overbought cluster. In fact, I tweeted that out right here. So if you take a look here at the sorry, that was it. Okay, so if you take a look at here, so this is the chart I shared with you, and this is when we were getting the cluster. We were at the time 27%. It's the highest in the last 20 years. It was not the highest of all time. It was actually the second highest of all time. The highest was right there in March of 2000. So that cluster right there, we were actually 23%. So had we finished with the cluster today, this would have been the strongest overbought cluster that we would have ever had on the Russell 2000. So an overbought cluster with the Russell, the highest above its 200-day moving average when we achieved the cluster than any other time in the Russell's history. So needless to say, today, and we barely finished off of the high. So that's all it took to come off of the high. So about what, 20 points, 20 plus points there, 22. That was enough to bring the momentum line out, because the momentum line was just barely up above the 80th percentile. All the other indicators did finish. In fact, the other thing about that is not only was it a cluster like these two, but it was a cluster with the market sentiment line above 82. So needless to say, the Russell 2000 had a really significant move, whereas on the other hand, the NASDAQ, this continues to come down. it's not bouncing up like the S&P and like the Russell, and has been kind of dragging lower. In fact, we're now getting a intermediate confirmation signal filling in that gap of that lower shadow there, and looking like we might continue to bounce up. So I think right now we're probably headed towards a new near-term run on the S&P. I don't know how long it's going to go and how high it's going to go, considering we've already been in a bullish run here for 2 months now on the S&P. The typical range is 1 to 3. We've been in it for going on now 3 months on the Russell 2000. So we've had a pretty decent run going already. And you know, again, we didn't have very much of an exhale. That was about as shallow of an exhale as you could possibly have and still be called an intermediate pullback. The intermediate line did come down. Market sentiment line actually came down, but we didn't go down. We barely flirted with what was the 23% retracement at the time. The orange line, as you can see, is the Fibonacci moves of the market sentiment rally. So a move off of the black one is the current intermediate run. This is the current intermediate run there. The orange one is the long-term, the market sentiment run off of the COVID low point. You can see if we pull back to a 23% retracement level there, then that's the pre-COVID high point. It would go through the Fibonacci retracement zone of this current run. But see, you would not expect an intermediate run pullback to begin until we break that 23% level there. So that's why I say don't get worked up with the noise, right? We can go up and down between 0 and 23 very easily. Again, considering how bullish we are, I don't expect this to go too far to the upside. Whereas to the downside, we can easily come down here to about 34.45. So we're looking at 340 points of downside risk. So that's almost 10% of downside risk if we were to get down towards that 23% retracement to the bottom of the retracement zone of this intermediate run. So that's almost 10%, 300 some odd points. I don't think we have 340 points of upside from here going forward, right? Obviously, we are up more than that, about almost 500 points off of the low on this current intermediate run. But I don't think we have another 300 plus points in addition to that 500 points to go. That would be a tremendous move off of this. And so that's why I say the reward from today going forward does not equal the risk on any kind of just normal exhale. This would be a normal exhale. Even coming down to the 38% retracement would still be almost, what would that be, 170 points to the downside to get down to that level. And again, I don't think we have 170 points of upside from here before we start that exhale. So it kind of just shows the risk reward that we have, again, from today going forward when you have stocks making that kind of blow off type move here at the end. All right, before we look at any other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That lets us know that you liked our video today and that you want us to do another video again tomorrow. It's a quick way to let us know that. If you don't like our videos, of course, you don't have to click on anything. But if you do like our videos and you want to let us know and you want us to do another one, let us know by one click. You can do it right now even while you're watching. Just hit that thumbs up icon. Also, while you're down there, hit a comment. What did you get out of our video today? What stood out to you? What did you learn? What questions or comments do you have? You can post those in the comment section or reply to other people's comments as well. As always, join our Market Scholars website. There's a link popping out there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content in between the videos from day to day. There's my handle right here at DavidSettle42. And join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, I invite you, as always, to check out these things over here on the right, our classes. These are our classes for our premium and our plus subscribers. Our premium subscribers have 3 years of access. Our plus subscribers are a month-to-month. Our plus subscribers have access to all of our trading rooms. Our Q&A sessions are for our premium subscribers. Our Market Outlook live videos, these are where I manage all the existing trades that we've done in these videos. When I do a Market Outlook video, I always do a live video at 3:30 Eastern time. I review all the trades I've done in previous videos to see if we need to close them or not. And then I make today's trade before the market closes here. So check that out there. Again, all of our subscribers, our premium and our plus subscribers, get access to that. Come down here, click on this heart. It opens up a new window. Hit that like button right there. Also hit this thumbs up icon, opens up another new tab, and hit that thumbs up icon here as well. Again, the more you do that, it benefits us because Twitter and Facebook will promote content to our followers, the content that has more engagements. So that's why we always ask for it. It also benefits you because Twitter and Facebook will promote content in your timelines from the accounts that you follow that you engage with the most. We try to make it really easy for you to engage with us here. All right, let's take a look back at the charts here, and as we looked at on Monday, we had a upper and a lower shadow. Has a look of a transition candle, even more so now on the Russell. The Russell now has got this long upper shadow that it didn't have before. Had a little bit smaller one. Now it's got a big upper one. So even more kind of looking like a transition candle. And again, you look at how far that the Russell right now, the PPO is, the 10 period moving average is above the 40. It is one of the highest periods that we've seen. If I hit OK and I just go back as far back as we can, we are in it is the PPO now on the weekly chart. Now it looks pretty crazy over there, but let me make sure I have a log scale on here. I don't know why it's not showing. Here, let me try something else here. I got log scale on, and I don't need to fit studies and see if that does it. There we go. So now you can see, okay, well, it doesn't have, it's pretty parabolic here, but, it doesn't look as bad as it did before, but still, we are 14, the 50-day or 10-week moving average is 14% above the 40-week moving average. Even in 2099, we weren't that high. Like, the highest we got was 13%, right here, 13.23, 13.29. That's the highest we got in March of 2000, 13.29. We got that pretty significant transition candle there, March of 2000. So we are now 14.33% up above, very, very high up above, and getting the beginnings of a transition candle. Not nearly as significant yet, but the beginnings of one. So it probably will take another one. In addition to that, because that's not, as you saw, we don't have a big candle. We're actually getting gradually smaller candles, and then now the body is about the same size. So a little different than what we saw back in over here, where we had big candles, kind of this big blow off type move there, and then we got that transition, and then we turned to the downside. Because you remember that transition candle right there, the March 13th candle. When you look at it on a regular candle, that's what it looks like there. So it's usually a bearish candle. The transition candle on the Hakinyashi usually is a bearish candle in and of itself, and obviously here's the makings of a transition candle, but it's not a bearish candle itself. So that's why I say it probably will take another one before we get another transition. But needless to say, the long-term momentum is higher on the Russell than it's ever been, at least on the data that we have here. That Thinkorswim is using. That's pretty significant. When you look at the NASDAQ, you can see the NASDAQ's been diverging on its long-term chart. If I were to go out, so you can kind of see it a little bit better. We had the big surge in September, and now we're getting new highs, but not as nearly as big of a surge. That sets up for divergence. That's classic definition for divergence there. And again, we're setting up for a transition candle here, and it's got the looks of one. But remember, this has got to be a bearish week, and so far it's more bearish than we've seen in a while. So, it's got the makings of a transition on the NASDAQ 100. And like I said, a move down to 20, until you break the 23% level, which is actually where that's of the COVID low point. The current near-term run, if I were to remove this and draw the Fibonacci line on the current near-term rally. So let's go candle trend, and we'll come off of really it's this low point here up to that high point. So right about in that area there. So this is coming off that October low point. So let me just kind of show you really quickly here. That's where it started, right? That's where the current intermediate run started. So now let's go back to the long-term chart for the NASDAQ 100. So again, we don't start an intermediate trend or pullback, until we break that 23% level. And then, like I said, We can pull all the way down here to this kind of 11,700 before we even come close to that market sentiment 23% line of this, which is, I think, worst case scenario for any pullback on any of these indexes. But that gap, that outperformance that the Nasdaq had over the Russell has been wiped clean away with the moves that we've had in the last so many weeks in the Russell, where we've really gone parabolic here. Let's take a look. Let's look at one more thing too on the Russell. This to show you how significant this move is today. We did pop back up above 30. So as bullish as we were going into the end of the year, we were that bullish again, but this time without the negative index getting as low and without the positive index getting as high. So we're still setting up for pretty decent divergence on the DMI on the Russell 2000. And you can see the spike here on the CCI above 200, but a spike above 70, but obviously not nearly as high as what it was. So we're setting up for divergence on that as well. And then finally looking at the two-line versions of some of these charts, you can see we're still gradually moving lower on SPY. It looks even more gradually bearish on the Qs, and we are below the 17-day moving average today. If we don't get back above that, you expect that we will. I expect, the market forecast member is showing a bullish intermediate confirmation, so we very well could. But if we don't, then we know that things are getting a little bit more bearish. And there's IWM, again, already setting up another divergence. We have been pretty bearish. We are bouncing. We did close briefly below or right at the 17-day. We bounced the last couple of days, and now we're already up to higher highs, and most likely won't get the higher highs on these indicators. Most likely, we'll see, but most likely there. So we're definitely setting up divergences on these indicators that can play themselves out here over the next little bit. Here's where this is the COVID low, but if I were to draw Fibonacci lines on the current intermediate run that we're on, remember it started back here in October. That was an intermediate pullback here. It was just a brief pause. So this is our current run that we're on right now. So breaking through that divergent low point here would start an intermediate pullback, which is kind of what we'd expect. And then there's where your support levels would be. All right, so now let's take a look at the intraday chart. And you can see, we're already up in the after hours pretty nicely on SPY, but we're off of the highs. We had a nice little continuation of this run. We did get up above Monday's high point on SPY. We did not get above Monday's high on the Qs. In fact, we barely filled in the gap from this morning on the Qs. That was pretty much only a gap on the Qs. IWM actually had a gap to the upside. And we talked about that in class today, that there's a very good chance that this gap on IWM is actually a blow-off top gap. So we'll see, how that ends up playing out here. But considering that there's not, there's not very much volume above us, but there's not very much below us either because of how fast we move. A little bit of a node there, but we can come back down into this area, 196, and fill in that gap just as easy as we went up. So again, it wouldn't be, if we did, we wouldn't be breaking the 23% retracement. So you can see until we break this level, any pullback is just noise, right? It's not even a pullback. It's just a drop. We won't be tanking. We won't be selling off. We won't be doing it. It would just be noise. So we can reverse today's move, fill in that gap, and people might go nuts, and the TV might go nuts. But the reality is it's just noise. And we've had a pretty decent move in the last couple of days. Until we reverse that completely and break this 191.5, then we would be on a pullback. And even then, it would just be an exhale. It wouldn't be, everybody breathes in, everybody breathes out. We don't go crazy when people exhale like they're going to die, right? Because even though we are like expelling oxygen instead of taking it in, we still don't think you're going to die, right? And there might be some news stories like, oh, so-and-so is breathing out oxygen. They're going to die. They're on the death's door. No, that's not how it works with normal people. That doesn't how it works for stocks either. We don't go crazy when we inhale like, hey, you did a great job of really breathing in that oxygen. We don't go crazy when we exhale. Same thing with stocks. The stocks go up. They come back down until you break significant support levels. It's just an inhale and just an exhale. let's take a look at volatility. Volatility kind of showed again, we did jump up at the end of the day, not surprising, but before we had jumped up, volatility had gotten pretty low again. It got down to 22. That doesn't look too low here on an absolute basis, but on a relative basis, we dropped back below 90% just briefly for a few hours this morning before ramping back up through. But again, we're not at 105%, so I don't think that we are starting an intermediate pullback yet. If that changes tomorrow, then that will change my opinion on that. But until then, I still think we'll probably get a little near-term run to the upside. We'll probably come back down towards 22, maybe even towards closer to 20 before we finally get more of an intermediate exhale where we do break those 23% retracement levels and start more of a pullback. So, from a market perspective, just to summarize our technical outlook, it seemed like, it was a surreal day on TV to see what was going on, but the market seemed to shrug it off because again, the market is, there was a little bit of a jump up in volatility and a little bit of a bounce up, but nothing significant, nothing that would spark more of an extended move. It's just a noisy move, and there's noisy moves to the upside, there's noisy moves to the downside, but eventually in the market, just kind of shrugs off the news and looks forward now, and so that's kind of a good example for everybody. But that's today's action hasn't changed the trend that we're on, and at some point in time, this trend is going to end. This intermediate run is going to end, and we're going to get an exhale. I just don't think it's here yet. It wasn't Monday. I don't think it is today. I think we'll continue to probably go up. We won't go up nearly as much as we have been. I think the Russell is kind of in blow-off mode right now. So even in 99 when we hit what was previously, what actually still is currently the most overbought cluster we've had since we didn't take over that title today. We would have, but we didn't finish with the cluster. But what still now is the most overbought back in 99 or 2000, early part of 2000. After we got that cluster, the Russell actually went up for another week and a half or so. Not very much, but it still went up for another week and a half or so. So that's why I say, I don't think we're going to be tanking here. I don't think we're going to be exhaling even here either. I still think we're going to kind of grind to the upside a little bit, fill in today's range on the S&P at least to the upside, go a little bit higher probably before we finally start playing out these divergences and breaking through those retracements and getting more of an extended multi-month pullback. Not where we'll drop for 2 months, but where we'll drop and then stay down for a month or two before we finally get a base that we can bounce off of and start a solid, intermediate multi-month and multiple potentially multi-month intermediate runs over the course of this year. So what do you think? Do you agree with that? Do you disagree? Let me know in the comment section, especially if you disagree. What are you looking at? What charts or indicators are you using that tell you why you should either be a lot more bullish than I am or a lot more bearish than I am? All right, just to kind of further illustrate the point that IWM is just blowing off here. I mean, this is a 30% return in the last 3 months. If I were to go out to where it actually bottomed out, let's see, it was actually over here in September where it really started its first leg higher. So right about there, September 24th, that initial low point. So starting on the 25th going forward from here in 2020, and then we'll go to a daily chart. So since that period, small caps are up 42% off of that low. So they started off and had a little bit of a pullback and then continued higher. Emerging markets are also doing very well, 23%. That's been a focus of ours in our long-term portfolios and at our Market Scholars portfolio management class. We've had a big focus on emerging markets. It's up 23% over the course of this past few months. Developed markets are even doing okay, whereas the other U.S. equities are lagging behind those internationals. Qs now and SPY has been this whole time lagging emerging markets. Commodities also doing very well. You can see bonds are way down and had a big down day today, and so is the U.S. dollar. The dollar's dropping like a rock. If I were to just go to today here, give it a second to do that. Here we go. Go to today and we'll look at a 10-day chart. So you can see bonds started off the day down, stayed down. Gold fell throughout the day and rallied a little bit. Small cap stocks started the day very strongly, up 5%. So consider like what went on today, and they still finished up 4%. And emerging markets ended up finishing down when things were really hitting the fan. Look at the Qs finishing down too at their lows of the day. So retesting the initial lows that the Qs had. So it kind of gives you an idea of what's working right now and what's not working. Remember, in a market cap weighted index like the S&P, when there's such a disparity in sector weightings, it's not, it's hard for small sectors to lead the market for an extended period of time and have the market actually rally. Again, only when there's a disparity, such a large disparity as there is now, when you see the Qs leading as much as they are. I did tweet out as well today. Here, let me bring up my Twitter again. It's over here. I tweeted out this concept of what's going on with the yield curve. So here is the 5-year inflation expectations, and you can see they've been dropping for a while, and you can see how the 10-year yield was pretty much matching on a relative basis, percentage basis, the moves in inflation expectations. But then, in coming off of the COVID lows, right about to that kind of July, August timeframe, inflation expectations jumped up. So we went from about 1.25%, obviously way down on the intra. This is a weekly chart, so intra-week basis. We were down to almost 1% at the end of that week, but fell all the way below 1% during the week. But then, by August, we rallied up to about 1.5%. So that's not too bad, right? Well, at that time, instead of coming back into this level, where the 10-year note was about 1%, a little over 1% at that time, it was down to 0.87%. So that gap right there, where inflation expectations rallied, but the 10-year yield hit its low point, that gap is just now starting to fill in. You can see since then, inflation expectations have gone up over 2%, and we started to rally. But you can see at 2%, that's higher than where we were last year. And at that point, the 10-year note was about 1.9%, 1.8%. We're nowhere close to 1.8% now. We're at about 1.04% over here. So it'd be using this one over here. So we were about 1.8% over here at these levels. At this level here, when we were previously just almost at 2% inflation expectations. We were almost at the 2% level. Now we're again nowhere close. We're only at 1%. So that's a pretty sizable gap, and that gap's gonna eventually fill back in. Like it's gonna these divergences play themselves out. So that will lead to with the Fed keeping rates zero, that's going to keep these really short-term rates down to nothing. But as we jump back up towards 2% on the 10-year yield, that's going to bring the yield spread up towards 2%. 2.5%, and that's when the Fed will start looking at raising interest rates again. That's what the Fed really pays attention to. And you can see when it got up here before, the Fed started to raise interest rates. When it got over here before, if it wasn't for the credit downgrade, the Fed would have started to raise interest rates over here. Eventually, we did peak back at the end of QE3. We got back up above. We got right back to about 250 basis points, and you can see the Fed started considering raising rates again. They first started tapering QE3, and the 2-year started to jump, and then they started to raise rates by the end of 15. And because the yield spread had gotten above 200 basis points, up to about 250, they started to consider raising rates. So when we get back up to 200 basis points again between the 10 and the 2-year, you will see the Fed can start to consider raising rates again, and that will most likely be by the end of the year. But that will be a significant move. So you take a look at something like the 10-year yield, which, like I said, is getting above 1% today for the first time, is also breaking above the 200-day moving average for the first time in a while. It hasn't, we don't have that golden cross yet, but we're getting really, really darn close to getting a golden cross on the 10-year note and making a run and starting in this kind of bullish time, which I fully expect that we'll get over the course of 2021. And what that looks like here on the Bollinger Bands, when you look at this great run that TLT has had, even all the way up here. Let me go to linear regression and go out to a long time frame here. So on a 20-year time frame, SPY is very, very high, but let's look at TLT. you can see TLT is still, up towards the upper end of this first standard deviation channel. We're still not oversold on long-term bonds like we were at the end of 2018 when we started this kind of fake bear market in U.S. and risk appetite. It started globally in the early part of 18, but really kicked in gear here in the U.S. in the end of 18. I've said before, is masked by the FANG stocks. So we're not to that point yet. There's a lot of downside in TLT that we have to go. And if I were to go out here, here's the 1 year chart. You see how today we broke to the bottom end of that Fibonacci of the value area in the 1 year chart. And we're starting to fill in this really big sizable gap because we moved up so much with the COVID low. We're starting to fill in that sizable gap in volume down towards about 140, which is where the next support level will be. So an opportunity for TLT to really start to drop here. Whether or not it does it right away remains to be seen, but you can see how it's definitely making it. See, it kind of made a big move to the downside outside the lower band. Last time we had this kind of a move outside the lower band, we actually rallied initially in bonds. So can we do something like that again and get back up towards 158? Definitely. Wouldn't be a significant bullish move, but it would just be kind of like, oh, that was a really sharp move. Let's reconcile that first before we can get more of a sustained move down to the downside. Obviously, the other big asset class that's been in discussions here today was the U.S. dollar. And you can see the U.S. dollar is just continuing to go down. Very strong bullish move on the euro to the upside. Just to kind of give you an idea of how bullish the euro is, or how bullish the euro is and how bearish the dollar is. That's a pretty significant move off of the 200-day moving average. In fact, if I were to go to the PPO here, and again, just show where we are now compared to the 40-week moving average. Again, we're in the 87th percentile of the past 5 years. If I go to the past 20 years, we are in the 74th percentile. So not extreme, but still, like I said, showed you before, pretty darn high right now. So it's just hard for the dollar to kind of extend its losses from here at the same degree without some kind of exhale here and with the major divergences that we're seeing on weekly charts with this move, with that first move there, and then the retest of that breakout and the secondary move. I wouldn't be surprised if we came back down towards 116 again on any kind of breather in risk appetite before we got more of a sustained slow grinding move in risk appetite to the upside. All right, now let's take a look at how the sectors perform. You can see financials, materials, energy, all led, industrials, utilities. I mean, all the smallest sectors in the S&P. They're not always the smallest sectors, but currently they are because of the disparity in the sector weightings with how big XLK has gotten in XLC. And you can see they dragged the S&P as a whole lower, even though all 5 of these sectors were up 2.5% or higher. The S&P was only up 0.5%, luckily, because of XLY being up 1%. The other 2 sectors really dragging it down towards the lower end of this performance. If you take a look, since that same time frame, since 9/24, since the low on 9/24, so starting on the 25th up until today. So let me do today here. There we go. You can see energy is up 35%. Financial stocks are up 31%. I mentioned this on Twitter as a trade that we've had going on our Market Outlook video. On a Market Outlook video I did at the end of August, we did a long call on Schwab. And Schwab has since then, we've rolled it 4 times. It just continue to roll and rack up the gains, locking in gains because of the rolls. Doing really well. You can see materials really have broken out in the last few days. They were kind of matching the market, matching some of these other sectors, and they really took off. You see XLK has gone in the wrong direction. XLK kind of peaked here at the end of the year, has been coming down ever since, while everything else has really popped. In fact, if we go to 1228 here, so let's go to 1228 of last year, the day that technology as a sector peaked, you can see it's down 2% since that day, whereas energy is up 7%, materials is up 6.5%, financials are up 5.5%. And S&P is only up 1 because these are all very small sectors. Healthcare is not so bad. It's up 3.5%. But consumer discretionary, communication services, which has Facebook and Google, as well as all those media companies, and then XLK, which has all Microsoft and Apple, as well as a lot of these other work from home companies that are in XLK. They're all down, again 2%, dragging the overall S&P down, even though you have some sectors that are up so much. A lot of those gains just coming literally in the last 2 days. If I go to just the last 2 days here, you can see that's where here. Let me do an intraday chart on that. And you can see that's where like energy took off yesterday, and materials and financials and industrials took off today. So in 2 days, those are the returns, even with the broader market itself up, because you have other sectors here, including some safe haven areas, down in those same 2 day period. In that same 2 day period, you take a look at the 12 grid here, and you can see kind of what's going on. XLK is moving back towards its moving average. Has light pink shading, not quite a yellow line. XLY, not so much. XLC has gotten light pink shading in the yellow line now. Remember, these are relatively bullish patterns in the short term. XLB is like, it did finish with the overbought cluster. Very, very strong move to kind of give you an idea of how strong it is. Let's come here to the market forecast chart. Let's take a look at MS PPO, and we'll go to the 200-day moving average. If it will let me. 200, and then we'll do just the 1 day, and it'll be simple moving average. Hit OK on that, and let's just go all the way, that as much time frame as XLB has. So we are now 19%, nearly 20% up above, which is in the 89th percentile. The only time the XLB has been higher was, again, back in May of 99. So right at the very beginning, it had that run. If it wasn't for, if I were to go out to, let's say, June 15th of 99, and take off that one period where we were just extremely high. We were at that point up 30, 26, 25, 30% here. So let's go June 15th of 1999 all the way up until now. So just that one brief little period, this is the highest, 19%, and getting a cluster here on that move of being 19% up above. If I were to, again, go back to that same time frame back in that early period here, so just give it a second to finish loading up. Go all the way back out to here. You can see during that time frame, we never did. I mean, it was so early on, we never did get a cluster. Probably would have gotten a few, maybe not. I mean, long upper shadows is tough. We might have gotten some clusters up here. We didn't have really any kind of blow off top. Maybe that day would have been a cluster with such a big, large range. That long upper shadow would have impacted the near term line, but the momentum line probably would have been higher there, and then we would have been grinding afterwards. Up. So here we are again. Big, strong move, very similar. At best, we probably just grind a little bit up here while we stay at really, really high levels for this after this cluster, and then we have some kind of corrective move, right? Something like that. I don't think we would go into a full-on bear market like we did, and eventually in 2000. But again, you can kind of get an idea of how significant, how significantly bullish some of these moves have been to get. Let's see, here they are. Get to that point. Energy is kind of bouncing up. Doesn't look so extreme. Industrials, financials looks like it came pretty darn close to its own little cluster. So let's come over here. Materials, remember, also has a market sentiment above 80, so it's a cluster with everything. All 4 lines up above 80. Financials, not so much. You can see here, financials are here. Let me go back to maximum. The XLF is above its 200-day moving average by 17%. That is in its 95th percentile. It's pretty rare for it to be this bullish here. And you can see the near-term line is what's kept it a little bit of a flat move. The near-term line is the only one that's down there. So some pretty extreme moves in some sectors, not so much in others. You can see real estate is dark pink shading in a red line. Staples is flirting with dark pink shading in a red line, whereas some of these others, you still have some pretty strong moves with others that are, again, XLK and XLC, which is the leadership of the market. That's why, they're showing some pretty good bullish bounce opportunities here. And that might lead the broader market to a little bit of a bounce in the short term before we get, like I said, that eventual intermediate exhale. All right, so that leads us to our trade idea of the day. And one stock in that, even though the technology sector as a whole didn't do as well, Cisco looks like it's already starting to do that light pink shading and yellow line bounce type pattern. Its intermediate line briefly it's dipping below the market sentiment line, but obviously looks like it might be starting to bounce back up above it. You can see from a 3 green arrow standpoint. We have 2 red arrows. We never did, we kind of flirted with that third one there on the moving average, but we're back up above it now. The MACD is rolling up higher on a 2-line basis. When you look at those same indicators with both their lines, you can see how the MACD and stochastics decline is slowing down. We're back above the 17-day moving average today. We were, obviously a lot better earlier, but we did barely get back above the 8-day as well. Excuse me. Take a look at the long-term chart, and you can see we had just barely broken the 200, a little bit of a retest of the 200 there, giving us an opportunity to continue to bounce. Not a whole lot of directional opportunity to the upside because there is a pretty significant volume node at the top of the value area at 46. So because of the bullish nature, but the lack of a directional opportunity, that leads us to doing a bull put spread. Even with earnings coming up, we can do bull put spread here, selling the 43 right in the mid-30s delta, buying the 41. So this is what it looks like. We did this trade earlier today, and you can see we're down a little bit since we got into it, but we got in with about 52 cents, which is about where we're at right now on this trade. And we'll see if we continue to bounce up, at least up to today's high point. If I look at the intraday range, you can see, there's the pullback, there's the bounce back up, a pretty good move here in the last 2 days to get off these lows, and now a little bit of a Fibonacci pullback, so to speak. And we'll see if we can hold and continue our run up through. We had gotten above the 4-week point of control. We get back above it by tomorrow, then it's going to have an opportunity to continue that run up. And it doesn't have to go very far. It just has to stay up above 43, which is where you got some pretty significant support down here. All right, so that does it for tonight. You've heard from me now. Now I want to hear from you. Use that link popping out right there to go to our Market Outlook forums. Open up any new threads there. It's a message board, so you can be able to reply to anybody else's threads. And let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Let us know that you liked our videos. Remember to do that on Twitter and Facebook as well. And comment on our videos. Have a great rest of your Wednesday night, everybody. And we'll see you all next time.